Hey everybody, thanks for joining me again for another Note Investing Strategy Hour. Just wanted to hop on really quick and give about another 30 seconds for some people to hop on, and then we will get this show going. Thanks for joining me. I look forward to chatting with everybody, and thank you for submitting your questions early so I can answer them directly. But I will hop back on in just about 30 more seconds here and we will get started. All right, everybody, we're going to get going here. Thank you for joining today. Um, Today we're going to talk about a little bit different. I know we normally talk about our notes specifically on this investment, on this call with our strategy hour. That's kind of the whole goal of it. But I wanted to do something that was a little bit different for this one and talk about all sorts of cash flowing assets, because there's all sorts of different types of them, and they do different things, and they do different things for your portfolio and what that can mean for you, and kind of a mindset that I want people to, I take, and I think it's great to take when we're looking at these cash flowing investments. Um, I'm excited to announce, the strategy hour. It's kind of been one-on-one with everybody, talking and talking to you guys. I've had some people come on, but we are kind of transitioning this year, and we'll actually be doing a show where Heather and I will be jumping on together in kind of a podcast style. So for this last one, I kind of wanted to use this and go through some different cash flowing assets and kind of a different type of mindset that some people take when looking at these investments for people and what that means. I'm going to adjust my seat really quick, but they're all different things, and people look at them differently. But the mindset that we're going to go over and talk about with you guys while I share the screen here is kind of being the portfolio CEO. So what this means is giving every dollar a job, giving people the ability to really take control of their portfolio and what that means for you as an investor, and how you can analyze what you're investing in before you get to a position where you're not really sure what's going on, and you don't hire the right assets for the job. Because as a portfolio, as an investor, your portfolio it's making you income. It's, you're buying assets, you're playing long-term goals. So you're the CEO of your portfolio. Um, so it's kind of a mindset shift here, because we don't want to become, an accidental investor. It doesn't mean that that's a wrong decision that's made, but you buy you buy a house because somebody told you you needed a rental property, or you have a 401k and you haven't looked at it, since 2010. And the problem isn't that you're losing money. The problem is that you're kind of accumulating assets randomly, and you have a collection of financial decisions, not a cohesive plan. So kind of putting a plan in place to help that. So the mindset shift that we're going to help is, you're the CEO. Joe, thanks for your question. I'm also interested to see what is available for non-accredited investor options, and I want to get my son involved. Joe, I'm happy to chat with you. I will send you an email after the stream, and we can talk about this. Um, but the mindset shift that we want to take when we're looking at our portfolios, your portfolio is a company, and you are making the hiring and kind of firing decisions with your assets and what you're investing in. You're an executive. Your job is to do that based on performance, not emotion, right? So every dollar here is an employee. Every single dollar you own is an employee of yours. Your job is to assign every dollar a specific role. If a dollar isn't working, it's stealing from the portfolio, and it's lazy capital. But right now, if you are kind of an accidental investor, I wish I had 100. Yeah, don't we all, Andrew? Uh, Andrew commented, I wish I had 100 Bitcoin in my junk drawer. So do I. But we're going to kind of go through some different asset classes and talk about how you can assign these jobs accurately and making sure that we're not assigning ones to a different role. So when we're hiring these portfolio assets, or our employees will say, we're gonna classify them in cash flow versus growth strategies. So your income is your operations is your income strategy. The job is here simple. Keeps the lights on, ensures that we're cash flowing, we're doing well. The personality of this kind of employee is boring. They're reliable. They show up on time every day. Not really a home run, but they are ensuring that the company survives, and their output is cash flow. With our growth minded, those are the visionaries of the company. Then those are the people that we want to see succeed, go to the moon. When your visionary kind of has a bad day, when the market dips, your lights go out, that's where we have to be aware of it and making sure that we're kind of balancing our portfolios. Again, it's not financial advice, it's just kind of a mindset when we're looking at these assets that we're going into and comparing and contrasting these different assets. Everybody's portfolio is different. Again, I'm not a financial advisor. This isn't financial advice. It's just a mindset that I see when I'm talking with a lot of these investors. So like I said, the operations, keep the lights on, predictable returns, cash flow focused, boring. And your kind of research and development, you're building the future, volatile but rewarding, and appreciation focused. And the main goal of this webinar is we're avoiding the mismatch. We don't want to see people that are trying to do a rental property thinking it's going to generate a huge amount of cash flow up front, or we're assigning people to the right role that we want them to do in our portfolio. So in order to do that with an employee, we're going to want to do an annual performance review. And if you're not, kind of diving into your annual performance review and auditing your portfolio or auditing the staff for the sake of this presentation, start and you can see how they actually perform. So this is where we're going to kind of go into some asset classes and talk about them. Again, none of these asset classes are bad. If you hold these assets, that's fantastic. It's exactly, very true. A lot of people buy rentals thinking it's building their liquidity, and it does the exact opposite. Exactly, Andrew. We're going to talk about this and kind of assign some personalities, as I would like to say for the sake of this webinar, to these individual assets. So if you're a CEO and you're hiring people, the personalities of these assets, what does that look like? So your rental property is kind of your needy manager. So this is, the resume of this is it claims passive income, but the performance review shows that this employee is kind of, it's high maintenance. They call you at midnight, toilet broke. They have months where they generate zero revenue because of vacancy. It isn't a passive employee of your portfolio. It's a needy middle manager. It generates growth, absolutely. There's no question about that. And you can hold for a long term. That's generating, growth as well. I understand that, but the cash flow comes kind of second with that. It's the second job attached to this asset. So Andrew brought up a good point with that. It's thinking it's a good way to build up liquidity. It's not liquidity. It's tied up into this individual asset. Well, I could just sell it. Well, you have to sell the asset to access the liquidity. So you have to essentially let this employee go to recover that liquidity. And then there's a few different asset classes in the real estate space we're going to go through, and then our general ones. But your next one is your fix and flip. This is kind of a gig worker, says fast cash. It's not a permanent employee. This is a gig worker. It's a contractor we hire for a short time. It generates cash for sure, very high profit if you're doing your correct strategies. You've evened out the P&L on this project of hiring this contractor, but it's active labor. If you stop supervising them, if you stop finding deals and managing the contractor, the revenue goes to zero immediately. You haven't built a business when you're doing you haven't built a portfolio asset here when you're doing a fix and flip. You built a job. Again, high in profit potentially, but this is an active job to do a fix and flip. Once you have an established strategy, there's a different thing, and it can be very profitable, of course. But this is a full-time job to manage when we're doing it well. And our other assets we go to is our traditional, our public markets. Call this one the Moody Genius. It's brilliant, but unpredictable, has high volatility. Of course, we have our long-term compounding, but over 20 years, that great employee you'll have. In the short term, emotional wreck, kind of high volatility, big emotional swings. Long-term, great employee. But short-term, it does have those mood swings. It gets emotional and it swings from high volume. And if you ask them for cash flow today, you're interrupting their work for the growth. Stocks are for growth. They're not for your cash flow. They're not for your paying bills. And then we have my favorite one for bias reasons. You have your private credit. Private credit, and it's funny, we talk about this all the time when we go to events and kind of these meetups that people sponsor that are, operators like ourselves, and everybody has this fun, interesting strategy. And, it's your private credit is kind of you're an accountant. It's they sit in the basement. They don't talk much, boring, simplistic, but they're reliable, consistent, and deliver on schedule. They'll give you a huge ton of massive upside, but they deliver a consistent paycheck every month, regardless of what other markets do or whatever other things in your portfolio act like. But boring, we talk about that with other operators that have different strategies, and they have all these shiny objects that we, are interesting to look in and can get people in the door immediately, but, kind of high volatility. These are private credits, simple and boring. It's interest on assets themselves. So you have, your promissory notes, or you have, a fixed rate option like for our funds. So it can be super simple, and promissory notes kind of dives into what we usually talk about on here, where it's long and you have your due diligence processes, and that's where it gets interesting. Can be a little bit more work, but we also have like a fixed rate fund that's probably extremely simple for a lot of you guys who are in the active investor space. It's wire the money, get the interest payments, and then we'll talk to you every time the distribution goes out. But they're your account. They're boring. So for this side, once we've kind of covered some assets, I know there's other assets. I know there's gold. A lot of people like gold. A lot of people like silver. They're great assets. I'm not a financial advisor. Make it part of your portfolio. But a gold it's an object. It doesn't earn cash flow. It's a stable growth metric. But what about the venture capital, aka the home run hitter, Andrew? Those are great. We could talk about those, but for the sake of the presentation, I didn't want to go off. It can be great, or it can be totally different. Investing in startups is definitely an option, or maybe the tightrope walk. it does give you those options, absolutely, in startup capital. I would definitely say it's not a home run hitter, it's a tightrope walker. If it makes it to the other side, that's going to be interesting. You'll do very well, but that tightrope's pretty thin. But we have we could, for this, I wanted to kind of like stop talking about theory with these asset classes. And we only have an hour here. I want to be sensitive of everybody's time and understand that, we're watching this webinar, and I appreciate everybody joining in. We talk about few assets, and I wanted to run this experiment from the sake of, the analogy I posted of this is your portfolio. You're acting as a CEO of this portfolio as a company, right? So we're going to run the simulation here of the $100,000 challenge and who pays the bills, and compare the monthly income from 100K invested in each of those asset classes we walked. And the venture capital one, true, I didn't bring that up because it'd be pretty hard to do these numbers. So we did our stock market one, which is your simple 6% dividend. I pulled these numbers from historical averages. That's where the data is coming from. You get your $500 a month cash flow. You give them 100 grand, and that's your dividend yield. Doesn't pay a mortgage, but it's a good cash flow option. Next, you have your rental property. This is where it gets. I did the 7% net rate. You put $100,000 down after the repair is mortgaged. It's it's on the higher end of a cap rate, but a solid income from a rental property. I did a $100,000 down payment because I think when people talk about these and they say, yeah, you invested 100 grand and you bought a rental property. Those exist in certain places. Where I'm located, they do not. But it's better, but you have to fix a toilet to get it, and you bought a part-time job. Fix and flip with this monthly recurring, there's no monthly recurring revenue. Obviously, if you want to refinance it into a rental, you have options there, but it's not a way to build up liquidity. It does the exact opposite if you refinance it into a rental property. But it does, these fix and flips, they have high upside on the sell if you can execute your exit strategy initially. Then you have, our fixed rate options. I used our rates for this for a $100,000 investment. You're getting $916 a month in income on that. Pretty straightforward options. Like I said, this is your fixed rate option is your accountant. That is the boring guy, simplistic. We don't really touch on anything. You put it in there and you can reinvest it, or you can get paid your monthly cash flow. So why does that matter? I had a chart here that I can't seem to pull up, but the chart it ranges, from your stock market, which is generating potentially on a 6% average yield. I know it ranges on the 30-year high, 6 to 7%. You got a $500, you got $583 on your rental property, as long as your HVAC doesn't go out, or any other properties. Or a fix and flip has a high upside once the exit strategy is performed, but monthly recurring revenue is 0, potentially negative. I didn't want to put that in there for the complexity of the webinar, and then you got your fixed rate options. These are the boring guys, private credit options of lending on an individual promissory note, or going into a fund that has a fixed rate options. It gives us, a wide range of what you can invest in this way. So why does that matter? So it's because of the sequence of returns. In CEO terms, it's a payroll crisis. If you rely on solely stocks, solely that first option to pay the bills, and the market wavers, you're forced to sell at a loss, firing your best talent, just at the worst time to keep the lights on. So the one we're talking about here, when we go into the CEO blueprint of the portfolio, again, I know I keep mentioning this because I don't want everybody to think I'm trying to teach you how to run a business. It's just an analogy. I saw that comment. Thank you, Joe. Thank you, Jonathan. I know it's not actually running a business. It's just about our portfolio and what it means for our investors as a mindset shift. Oops. Slides are all over the place here. So the mindset shift is you build your portfolio like a pyramid as the way a business runs. So you have your operations first, calculate, your burn rate. This is what you need to live, your mortgage, cars, food, covers 100% of that, whatever it may be when you're trying to live off this passive investment. Predictable income before you take any growth risks, right? Once the bills are paid, then you hire the visionaries. You invest your surplus capital into these growth assets. If they take 10 years to pay off, doesn't matter. Your lifestyle is already funded. You have a solid base of your reliable employees, right? This is where you can talk about your venture capital, your big crypto gains you want to play. So that is the pyramid you start with. So your execution on that, hire operations first, cover your burn rate with predictable income before taking growth risks, and then you hire your visionaries, your research and development, and invest your surplus capital in assets. So when you assign your dollar as the CEO of your portfolio, you got to look at your dollars. Are you asking, a visionary, to do an accountant's job? Are you asking your crypto to do what a fixed rate option should be, what a promissory note investor should be? Every dollar has a job, and make sure that's the right job for that, what you're looking to gain out of that asset. Oops. Fix the org chart, hire the role, and then do a deep due diligence before you actually go in and hire this asset. When you want to invest in an asset, do a deep due diligence and investigate what you're actually getting into. What does that mean from an investor standpoint? That goes into doing due diligence on an operator, researching, the individual stock if it is, what that means, why you're investing in it. Obviously, the S&P 500 is really straightforward, but investigate what you're actually getting involved in before hiring them, and you're investing capital into these individual entities and what they are. Then crypto, do a deep dive on that to understand what you are. You got gold is straightforward, and then with private credit with us, what that looks like is do a due diligence on an operator. Somebody's offering you crazy returns that are really attractive. Investigate further, figure out why they're offering what they're offering, what that means, and what it goes through to invest with us, and what it means to invest with this operator. Why are they providing that? Is it because they are fantastic and they have a great track record, or do they have no track record and they're reaching for the skies trying to provide you, all the dreams you want to just get your capital in the door, right? And I know I have some of your guys' questions coming through. I promise I will answer them. We just do have to go through our traditional part of this the webinar, where we're going to talk about our notes some notes we have available, a couple of deals for everybody, and it ties into cash flow. I promise I'll get to your questions, but just make sure to assign the dollar, do an audit of your portfolio, make sure that you have assigned the jobs and you have these investments in the correct category, and they're performing the way you would assume them to perform. Okay, I'm reading your question. Just a sec. Okay. Sorry, technical fix. So now that we have that, kind of covered our basis with that value out here, we can go over a couple of deals we have. Of course, so you guys know, as I mentioned earlier, Central Lending has our fixed rate option. It's a 4-month or a 12-month or 24-month note. It's dependent on what you invest and how long you invest it. But we're going to go through our notes as we typically do on this call after I answer 2 of these questions here. So let me pull this off here. You have to account for keeping what you have, which is why managing your tax liability is important. Therefore, real estate and commodities could allow you to keep everything you've earned. Exactly. Doesn't mean that any of those assets that I mentioned are indifferent. That is a great point, Joe, to make. and very accurate. Okay. And Robert, okay. Robert, I flipped houses before and made decent money. Why should I lend to you for 11% when I could go flip a house myself and maybe make 20%? That's a great question, and if you have an established strategy, you can keep going with that. Our investments on this that I just mentioned they're a passive side of things. It's a way to kind of set it and forget it. With the fix and flip, it is an active strategy, is why I mentioned that. It's just a little bit of a, kind of a different insight and different view to look at these things. But good question on that, Robert. And if you are flipping houses, you can click that link on the screen, and we'd love to take a look at your deal here. You can submit that deal here if you are still flipping. But great question on that. Sarah, I'm worried about the real estate market crashing. If housing drops 20%, what happens to my investment? Depends on what asset class you're in. If you're in a rental, I think there's one of the best advices on that is if you're in a rental property and it's sustaining, the market crashes don't affect you because you haven't sold it yet. You don't lose if you don't sell. And for us at Central Lending, it's exactly, we use our 65% loan to value when we're originating capital, 65 to 75%. Think of it as a buffer. If the house is worth 100 grand, we only lend 65% to the borrower. The flipper puts in the equity gap. If the market drops, about 20%, house is still worth 80,000. Our loan is only 65,000, so fully covered on that. And the equity, the investor would then take that loss. Good question. Michael, you're offering rates between 10 and 11% on these notes. That sounds high compared to a CD. How are you generating that cash to pay us? Totally fair question. This is a great question you should be able to ask every operator that you talk with. That how are you making money on it? So we are essentially, to answer this question in terms of like traditional banks and then private credit, we're basically cutting out the middleman. When a bank takes it on at the CD, our borrowers, what we do is we lend the capital out, and once the capital closes on the fund, and and the fund gets paid the origination points, we will then go and sell that loan to other capital providers and retain that interest spread. So we'll retain a 1% to 2% spread on all of these loans that we originate, and then we will then be able to recycle that capital and go deploy it into another loan. So out of our fund, when a borrower wants a loan, we'll say lend them $100,000 at 10% interest. They will pay their origination points up front. We split the origination points with our fund, and we will then take that loan and sell it to a institutional capital provider at an 8% spread. The fund then retains that 2% interest, recaptures that capital, and we can go deploy it into another loan. I know we have a few more questions here, but this is a great segue to talk about, to look at a few deals we have and kind of tie in some of this cash flow options. Share my screen here. And I can talk about these loans with you guys. Oops. We have our loans here. So here's a few deals there that we can talk about here just based off of, Jonathan, your question there, like what do our deals look like as far as a promissory note investment? So here's a few of them for an example. We have, this loan is a $59,000 loan. It has a borrower has track record of 3 deals. LTV ARV that I answered that question on, as far as the market, what that looks like. It's a $59,000 investment. Your monthly cash flow on that one's $486. Going into one in Detroit. Rob, why isn't my chat box moving more with the questions? Rob, I don't know if you're talking about the other questions I've asked, but it might be a technical issue, but we're also on multiple different platforms, so the audience can't see all of the questions that come through. But this one, we have a $103,000 investment out of Michigan. You can see borrower is bringing a 10.49% rate. It's a $902 monthly payment. 42% loan to value. One out of Lakeland. So you see there's a lot of different cash flowing options for these investments. Okay. There's one in Greeley. $62,000 investment. Gets you 10.49%. Cash flow of $543 a month. This one out of Lakeland. $66,000 investment. Borrower's bringing $30,000 down. See a 9.49% rate. I know it's crazy. The rates are falling, people. So these rates on these notes, we lend out with the market. But you have still a $521 monthly payment. Interest-only payments. What that does is means the borrower is going to make these interest-only payments, and at the end of the loan, he will then pay back that original principal in a balloon payment. So you'll receive all of that, all of your initial investment back, as long as the loan is executed properly and gets their exits back. Okay, I have about 15 questions from some investors from the form I sent out. If you want to be on my question form for the webinar that I send out, you can drop a comment in the chat below and I will add you, because I'm going to answer these questions first that come in, and then we'll do the live section. I know it was a shorter one with the deals coming through, but I did get quite a bit of these questions I wanted to answer because some of them provide some good value. And we'll go through, and then we'll go through the live questions if we have any. So great question regarding taxes. I hate paying ordinary income tax. Does the note offer any tax benefits? So again, I'm not a CPA, so talk with your tax professional. Debt generally generates interest income, and the IRS does treat that like ordinary income, same as salary. So if you want tax efficiency, again, meet with an advisor and discuss that with them. But you can invest in these notes using your self-directed IRA or any qualified retirement accounts, and you are able to also reinvest those earnings if they're in the fund. But you can still purchase those individual promissory notes in a retirement account that is either tax deferred or tax free. So if you have retirement funds sitting idle, it's definitely a great option. You need to hire an accountant, talk with them. But if you're looking for some self-directed IRA referrals, I'm happy to give you some custodians we work with and answer that question. And then we're going to our next question. What happens if a borrower stops paying you? Do my payments stop? Since we talked about both of the fund fixed options and then the promissory note options, I'm going to answer this in a two-part question. So thank you, Marcus, for this question. This is a great question. If you are in the fund, if a borrower stops paying on an individual loan that the fund owns and hasn't sold to an investor, it affects cash flow for the overall fund. But we are arbitraging that capital. So if it's owned by a private investor and you fund that loan individually, the lender who purchased that loan is then going to have to go into the default metric and probably foreclose on the asset. But the fund itself, if it's kind of the power of it, if we have one borrower that stops paying, your money is pulled across, many loans. And then questions. Joe, I will get you that email on that once I go through. Sorry, this form submission has like 3 pages I have to go through. I will get you the form for the questions, but okay. Going to our next question. James, I hope you're watching right now. I don't need the monthly income right now to pay bills. Can I just let the interest roll over and compound? We did talk about this, but absolutely, James, you can, how you turn into it can reinvest into the principal itself. Yes. We don't send it to you. It'll automatically roll over into your investment and on your note principal. In the fund option, if it's an individual promissory note, the payments will be made to however it was invested. Peter, you say on these webinars that you lend at a maximum of 70 to 70% loan to value, but who determines the value? Are you just guessing, or is the borrower guessing? No, we don't trust borrower math. We operate typical as an institution. We order independent reports from richer values, and we look at the as-is value today, and as well as the ARV for tomorrow, and we lend on that data. If the appraisal doesn't support that, it's not typically a deal we want to go, and that's a valuable tool for the borrower as well. Hey, Tom, thanks for the question. Thanks. Glad to see you, Tom. If the Fed cuts rate next year, does my return go down? If you buy a secured note today, you're locking in your rate for that term. We give you a 12-month term and the Fed cuts rates tomorrow, that rate is continued until the borrower either makes their exit, or if you're in the fund, you're locking in that term. Our loans don't have a payoff penalty, so we can pay off the loan at any time as a fund, or the borrower can pay off the loan at any time. But as far as the rate goes, the rate is locked in. It's a fixed rate. It's not, a float rate savings account. It's a straight fixed rate. Lisa, what's the minimum to get started? Do I need $100,000 like you said in the example? No, you do not need $100,000 to get started. The minimum for our fund is $50,000, and then our notes generally range. We have a wide range. Smaller deals are harder to come by. We try and make it accessible, but they're harder to come by. Kind of need a wide range for that. And your second part, for the fund, you do have to be an accredited investor, and for our promissory notes, they're open to any investor to partake in. Hi, Mark. Thanks for the question, man. Good to see you. How long, on average, are these loans do you make to borrowers? Are these long-term locked in for 5+ years or to 30 years? No, we're short-term lender. So our borrowers typically our maximum term is 24 months. So our borrowers can pay off at any time, but no, we are a short-term lender, and we're not stuck in a loan for 30 years. Thanks for that question, Mark. Okay, scroll to the next page here. Just don't have any more live coming in right now. This sounds... I don't... Apologies. Okay, Carl, I appreciate you, our conversation we had earlier. You showing up to the webinar, that's cool. But your question you asked is, this sounds too good, but the rate sounds good. Do you or the company have your own money in the fund? We have staff members with capital in the fund. Yes, they do have skin in the game. But as far as, from a central lending perspective, that's where on the fund option, the profit split on the equity side comes in. And Rob, are loan rates tied to any index? If you're speaking on loan rates tied to what we're originating at, we are trying to stay competitive with, if the Fed drops rates and, our traditional lenders are dropping rates, we are staying competitive. We want to attract a higher borrower pool, and in turn that'll affect the note rates in the fund that we offer if they drop. Thank you, Rob, for that question. And then, I hope Andrew's still in this chat. This is a great question. Why would a borrower come to you and pay 12%, 10 to 12% instead of going to a bank? This is a really common question in the space, but it's speed and certainty. A bank can take 60 to 90 days to close a loan, and they want 3 years of tax returns and pretty much a blood sample. If you need to move quickly, we can close very quickly, and they pay us that premium because we move at the speed. The cost of losing the deal for some investors is higher than the interest rates that we charge. Okay, Kevin, thanks for that question. This is my brother flips houses from Kevin. My brother flips houses. Should I lend to him directly instead? That's kind of personal preference on what you want to get yourself into. I personally have a rule. I don't lend anything to family that I'm not comfortable losing, because then that changes the relationship. But that would be a personal decision for yourself, Kevin. I can't give you advice on what to do on that. It depends on your relationship with them, but I appreciate the question on that one. And then, Rob, your question is, how many loans do you turn over a year? I just want to make sure, if you're still in this chat, that I can answer this properly. Are you talking about how many loans that we sell to our institutional partners once we close them, or are you speaking to how many loans we close in general? Because we sell on average to institutional partners $1 to $3 million a week, depending on origination volume. And then, Rob, since you're in the direct chat here, you can, if that answers what you're looking for, $1 to $3 million a week, depending on origination. We'll churn our entire fund, 7 to 10 times a year. So all of our investor capital. Okay, and then our investor, Natalie, if interest rates keep going up or down, are you stuck with the low rates if they go up, or are you stuck with the old rate you signed up with? If it's an individual promissory note, if rates go up, it doesn't affect the rate unless, depending on the loan structure. In the fund, we adjust rates quarterly. And Rob, your loans in general? Loans in general, I'm just pulling the stats here on what we closed last year, just to make sure. Sorry, my audio is cutting out here. So Rob, we've closed 1,600 loans, a little bit over that. Rob, your rate for a 2-year loan, what is that, and what do we need to apply? If you want to apply on that, Rob, let me just direct message you this link here on what you can apply for. Can pop this on the screen really quick for you, Rob. You can connect with our loan origination team. Just so everybody can see me, or you can submit the deal right here in that top corner. You can scan that QR code and you can submit that deal. Okay, Oscar, Kade, we spoke about a month ago. Just wanted to check. Thanks for doing this. Wanted to check back in. How exactly do I get paid again? Do you mail a check or is it direct deposit? If you want to check, we can mail it to you, but we prefer the when you're invested with us as far as the fund goes. I know Oscar we had discussed the fund. It's an ACH deposit or into your bank account every month. That's funny. Yeah. Oscar, in the bottom of this question asks, I know we live in the 21st century, but I just wanted to ask if a check was still an option. Yeah, we could talk about that, but typically our earnings are sent via ACH. And Rob, again, if you can scan that link and directly submit the deal there. I just want to make sure you're taken care of. I will shoot you a message privately and get you connected with a member of our team. You guys, thank you, Eleanor. You guys seem great, but what happens if you or somebody else disappear tomorrow? Does the fund dissolve? No, Central Lending is not a one-man show. We have an executive team. If something happens to one of us, we'll step in and we have a third-party administrator in place with Verivest to kind of ensure that the books are always independent and accessible. But it would be depending on the severity of the situation. But no, we would not just go away if I disappeared. I appreciate the value of that. Rob, so you do both active and passive loans? Correct. So we offer, if an investor wants to purchase a property, they can go through us directly and we're able to fund their deal. And then if a private investor wants to invest capital with us, we do offer a promissory note investment, Rob. And those terms are dependent on how long you want your capital tied up. If you're a passive investor, we have 4-month terms, 12-month terms, and 24-month terms. But I can get you connected with one of our account executives if you're looking for funding, and I can reach out to you directly on that. And another one from Oscar here. If I start with a $50,000 minimum, can I add more later, or do I have to buy a whole new note? No, you wouldn't have to buy. If it's an individual promissory note, you can't add more to it. It's just the principal amount that you would then fund. But if you're wanting to add more to your investment in the fund, we would just amend the maturity date, and then you could make contributions to that investment. Rob, do you have a property list available? Yes, we do. I will shoot you over that details. If you want to get added to that, you can also I'll message you directly and provide you that loan information and what that looks like. Okay, and then I just saw another question. Sorry about that, Walter. Um, Apologies. Can I look at a list of specific loans you have and pick which specific houses I want to fund? I know my local market better than you do. Yeah, we get that a lot. Yes, I will cherry pick a few deals from you. Uh, if you're looking to fund individual promissory notes, Walter, I can shoot you an email after this, and I will find your area of expertise. Or you can comment again, and I can answer those for you. I'm happy to cherry pick some deals for you. Yep, no problem. I will shoot you that message. There's one more here I missed here before we close this bad one out. Alex, thanks for the question. What's to stop you from taking this money and investing it in other options than real estate if the market slows down? I've never done this type of investment before, and I was just curious what that looks like from an operations standpoint. How do I know it'll stay invested in real estate? It's a good question. I understand that if it's a new world to you. We're Our operating agreement essentially is the answer to your question. We're legally defined as a real estate debt fund. We can originate loans, buy mortgages, and manage real estate collateral. We can't wake up to tomorrow and become a crypto hedge fund. It'd be a violation, so we stay in our lane. Are there any fees associated with investing in your fund, from Nancy? We charge the fee on the asset under management. It includes the loan portfolio and the cash held for deployment. It's not charged to the individual investor. And we're incentivized to deploy as much as we can because that's how we make our profit on the fund and in the profit split once we reach our preferred rate of return to our investors, Nancy. Chris? Because it looks like our last question here, and then I'm caught up here. Sorry, I'm scrolling here. I know there's a lockup, but what if I had a medical emergency or hardship? Am I totally stuck? No, we're not. The lockup period is tied up for the capital, but we're not robots. If there was a crisis, we can redeem you early. Typically, there's a 5% redemption fee if you're in a fund. Think of it kind of as an early withdrawal penalty, but we're not robots here. We are human. But that is a general answer to that is under normal circumstances out of the fund, there's a 5% redemption fee, but we understand that emergencies can happen. Looks like another question from Rob here, and then we'll wrap this thing up. Is this going to close in 5 years, or does it keep going? You mentioned maturity dates and end times. What do I do if I want to keep investing? No, we're an open-ended fund that's called the Evergreen Fund. It's an evergreen fund. It's ongoing until we want to wind it down. You can stay in the fund for however long you want as an equity member. Where the maturity date is associated with is our debt options. Those investments do have a hard maturity date. Doesn't mean we won't allow you to re-up on when the maturity date hits, but they are associated with an initial maturity date when you invest. But the debt fund is an evergreen fund, and I'm happy to answer any of those questions. Rob, do you have more operational information on your website along with the terms and conditions agreements? Yes, Rob, I'll shoot you a copy of that in that email. I'm going to follow up with you after this webinar, and it looks like that was kind of our last question here. So we're going to wrap this up, and thank you guys for the 4 people here new guys who joined my note blast. There will be one going out tomorrow, and I appreciate you guys hanging out with me and answering all these great questions. It's fun to interact with this, and like I said, I'm excited. Heather and I are changing it up. We're going to have a more podcast style. So these questions, if you want to get in on the questions that I answered and I send out before the webinar, drop your email. I'll shoot it to you and follow up. And you can submit your questions. You don't have to be online and watching the webinar. We also send out replays. So if you have a question, you're not going to be able to make the time, I'll send it out to you and you can submit your questions. And then Rob, yes, that'll be included in all the information I give you, and including term sheets and what that looks like from your perspective, and I'll connect you with that team on that side. But I don't think there's any more questions here that I could see, but thank you guys for hanging out with me. I enjoy this. I enjoy talking with you and the interaction that we have. I think it's fun. I like to do a little value add. I know it's kind of at the beginning, it's slow and can't ask your questions as much as because I'm going off of a presentation, but I do enjoy the latter half of these, being able to interact with you guys and answer your questions. So really thanks for hanging out with me, and I will be sending out an email to you if you're registered and you're on this webinar to join the list for you to submit your questions. I appreciate you guys hanging out, and if you have any questions, feel free. I'm going to put this up here again, and you can connect with me. I'm happy to answer any questions you have. Regarding our investment offerings, I'll put that on the screen really quick. Go ahead and scan that and connect with me directly. Happy to answer your questions again. One thing I wanted to do here, hang on, while we're having fun. Look at this, check this out. I don't know if you can hear that, yeah. But again, thank you guys for hanging out. I'm excited to help you guys. Need to have every participant see all the questions being asked. I understand, Rob. Yeah, it's just it's a software platform. I can't show people what's on Instagram or pre-asked questions, but I will work on that. Again, thank you guys. Have a great rest of your day. I appreciate you joining me, and I will see you guys next time.